good afternoon and welcome to everyone watching the Section 12J webinar, the new normal, all of these webinars that we're doing at the moment, which has the one disadvantage that I can't see everyone who's watching, but the other big advantage is that we're reaching more people than I think the conference industry ever has, because you can do this on a cold day like today from the comfort of your very warm living room. So I hope you're all warm. You've got your coffee. I'm Michael Avery, host of Classic Business and COVID-19 Business Watch on Business Day TV, and editor of Catalyst Private Equity magazine for my sins as well, which is really where I first became aware of Section 12J as an asset class. And I think one of the main challenges to the growth of small and medium-sized businesses and junior mining exploration companies in South Africa in particular is access to equity finance. And to assist these sectors in terms of equity finance, government has implemented this tax incentive for investors in enterprises through a venture capital company regime. It's a very interesting way of stimulating equity capital into these companies. They're intended to be a marketing vehicle, these VCCs that will attract retail investors. And I think as an investor, any taxpayer who qualifies to invest in an approved VCC, these are absolutely critical components of portfolio planning, as we've come to see over the last few years. A big appetite, lots of subscription. Not without some controversy as well. I think some managers have sailed fairly close to the wind around whether or not their investments are true to the spirit of the legislation. But be that as it may, I think it's still a growing asset class of some repute. And I think there are a couple of misconceptions as well. The one glaring misconception is that Section 12J merely delays tax and investors get nailed in the end with capital gains tax. But that certainly isn't the case at all. Now, with that, I'm going to hand over to John T. Sachs, who's going to tell you a little bit more about Jaltech. There's obviously lots of discussion at the moment around how Section 12Js have weathered the COVID storm. There's lots of dry powder around, and the debate is how to deploy that dry powder, and whether or not we should go into the debt side or just remain on the equity side. But with that, firstly, I'd like to hand over to John T. Sachs, partner of Jaltech, to share a little bit more about the firm and what it is that they do. John T.
Michael, thanks. And obviously, thanks for hosting today. We appreciate it. Jaltech is a fund formation, administration, and management business. Effectively, we have two focuses. One is we set up property, private equity, debt funds, and Section 12J funds for our clients. In the Section 12J market, we're probably one of the largest. We have about 1.7 billion Rand of assets under administration. That's the one side of our business. The other side is we're a Section 12J fund manager. We have a number of Section 12J funds where we manage approximately 1.1 billion Rand of investors' capital. And then there are other areas in the Section 12J market that we're also active in. We have a Section 12J conference called the 12J Marketplace Conference. We get about 1,000 people per year attending this conference. We own Abacus Funding Solutions, which is a lending business to Section 12J investors. So if you wanted to invest into one of our funds, you could invest 55 Rand. We would lend you 45. You'd get your refund of, say, 45 Rand and pay off your loan within a couple of months. So we're very active in the 12J market. And the impact of COVID is a really important issue to address.
Now, we talk about the impact of COVID. Obviously, investors right now are quite fearful. There's a lot of volatility in the market, but they're also very aware that perhaps the only guaranteed returns that you can get are by paying off debt, but also by managing how much one is paying in tax at the end of the day. And I mentioned earlier on in my introduction that there's a debate currently going on around whether or not Section 12J should be opened up to debt as well as equity. What are your thoughts on that?
I think the whole premise around Section 12J, and one could even call it the spirit of Section 12J, is to provide equity funding to SMEs. I think Section 12J companies shouldn't be allowed to provide debt funding, particularly in a difficult economic and challenging environment. You don't want to be providing debt funding to SMEs because invariably they will underperform and not be able to pay off the debt, and as a result, probably be liquidated. What these SMEs need is equity funding, and that's exactly what 12J is. They need an investment partner who's with them, during difficult times and for longer term. So I think 12J, if ever there's a need for this type of incentive, it's now. We are at a point in time where we'll be finding out shortly, we think, whether Section 12J will be extended. And if ever Treasury thought of extending 12J, it's now. I think the pool of capital that every year is being invested into 12J will really help these SMEs. So from a debt to equity debate, I think there's no debate really. The whole purpose of 12J was equity funding.
Absolutely. Why now, though? Why is it so critical now? Isn't it extremely difficult now to be deploying capital into these SMEs during such an uncertain time where forecasting is very difficult to do? Why now?
Yeah, so I think, the type of measures one takes when investing into these businesses, it's an in-depth due diligence process. Why now? I think no fund manager should be rushing into investments. I think businesses that are underperforming, significantly, they're going to struggle to raise funding from a 12J or anyone. But there are a number of really unbelievable businesses that have, they would never have considered it a private equity partner because the businesses are just doing so well. Take, for example, some great hotel businesses or some, unbelievable conferencing businesses where in the past they've just done so unbelievably well. But now what they don't have is a balance sheet. They don't have cash that allows them to be sustainable for the next 6 to 12 to 18 months. And those are the type of businesses which I think will attract 12J or private equity capital, and they will give those investors an unbelievable return once lockdown is over. So, I think it's an unbelievable investment opportunity. I think it is a dangerous one. I think it's a very, fund managers need to be unbelievably cautious, but I think the opportunities are going to be really good.
And it also means you're able, as a capital provider coming in, taking equity stakes in these businesses, to come in on very advantageous terms when you structure these transactions. I'm sure you're able to do them on multiples that, provided you do see growth in the 5-year period, wouldn't have been available pre-COVID.
No, absolutely. I don't want to be insensitive to entrepreneurs who've spent their lives building unbelievable businesses. We're in a very advantageous position. The private equity investments we're taking are much riskier now, given the uncertainty that the market holds. So the entrepreneurs are a bit on the back foot. I don't think fund managers should be taking significant advantage of them, but I do think that the opportunity for upside now, is better than ever for a private equity investor.
Absolutely. I mean, one, obviously being mindful of all the work that the entrepreneurs and the jockeys are putting in, and that's the balance here as an investor, partnering with these jockeys, but also having to show decent returns to your investors as well. There is an inherent tension, but it also creates, I think, a very good market discipline in the entire model, which is another one of its advantages. Now, let's look at some of the funds that you've invested in at the moment. Firstly, you've got the Infinity Anchor Fund. Just give us an overview of this particular fund.
Also, Infinity is an asset rental fund. We effectively raise capital and we invest into businesses that generate income from the rental of, for example, fiber infrastructure, tech, medical equipment, etc. And we're really looking for businesses that generate rental income. We like these businesses for a few reasons. One main reason is because they generate so much income, it allows us to pay dividends to our investors. Last year, we paid out 2 dividends. In this fund, we paid out a dividend in April. And, this is a great fund for investors who, anticipate a 6th monthly dividend. It's a healthy fund. It's done really well. If we look at our most recent fund fact sheet, our annualized return, if you ignore the tax benefit as a pure investment, this has had an annualized yield of around 9%. With the tax benefit, which you can't ignore because you would have paid the tax, there was a yield of 16%. So really healthy fund. And my one partner, Gaurav Nair, who's an actuary, he's the CEO of the fund and runs it pretty much full time.
Yeah, I don't know of many investments that are delivering CPI plus 12 in this environment. I think that speaks for itself. What have you targeted as the IRR over the life of this fund?
We're targeting currently an IRR of 17.5% with a tax benefit, which amounts to about 9% without the tax benefit. Yeah.
And then perhaps it's a good time now to talk about how performance fees work inside the Section 12J model, John T, because I think some people might be fearful whenever they hear venture capital or private equity, they think massive fees, 2 and 20%, and really it isn't like that.
So, I think there are a couple of issues with any investment class. In 12J, for me, there are two issues. One is deployment and the other one is fees. So if you look at the standard, not standard, but a number of the larger players, their performance fee is such an overwhelming percentage of the client's profits that it really takes away a lot of their performance and their ability to perform. As a business, our model across all our funds is if you invest 100 Rand with us, if it grows to 120 Rand, we only take a performance fee of 20% on the 20 Rand growth, where competing funds, they'll look at your tax benefit and really charge you from a risk capital or net capital base, which at the end of the day takes a large chunk of the client's return. So we work on a gross performance fee.
Oh, yeah, one of the important differentiators in the marketplace. So what's the impact of COVID-19 been on the current investments inside the Infinity Anchor Fund?
So, I don't think any fund manager can tell you in the current market that, they're completely unaffected. We are, where we've been significantly affected is our investment pipeline. Pre-28 February, we're very proud of the fact that, one, we had invested 100% of our historic investors' capital. We weren't sitting on any dry powder, as you put it. So what we typically do is we go to market, we look for investments, we sign term sheets with a number of potential investment companies, and we secure our investment pipeline. But because of COVID-19, the huge pipeline of investments that we had generated, most of those have been eroded. These businesses are great businesses, but unfortunately, they're not going to generate the returns we need to generate for our investors. So a large portion of our pipeline has been completely eroded. There are a couple of really great businesses that we're looking to invest in. If I, talk to that, we're looking at a business in the fiber infrastructure space. What they do is they monopolize an estate or an apartment complex by installing fiber routers in the complex. And instead of the resident having his own modem in his house, which is connected to a fiber cable that's been laid, they really connect to these large modems. And they're buying data from the investing company or its holding company at a significantly lower price. So instead of paying 500 Rand as an example, they're paying 200 Rand. So this business is really a great investment opportunity. Pre-COVID did well. During COVID, it's doing exceptionally well because everyone's stuck at home. And after COVID, it'll continue to do well. So those are the type of investments that we're looking at. At our current portfolio, miraculously completely unaffected. This isn't because we're the smartest in the market or the best fund manager. We've just been really extremely lucky. A large portion of our portfolio is in the security sector. For example, a company we invest in is Secutech. Their holding company rents out security cameras to security companies, and who then rent out or charge a fee to the residents. So the company doesn't take any consumer risk. It takes, corporate risk, which is much lower. These are typically, really, really healthy businesses that it rents out to. So, the portfolio is unaffected. And what that's really given us, and really as a business, an unbelievable opportunity to focus on growing the business and managing our current portfolio. We're not spending any time on, dealing with underperforming assets. We're not resuscitating our investee companies. We're focusing on growth and maintenance. And that's, as a fund manager in this environment, is almost unheard of. So it's given us a great advantage. We're looking for investments. We're not rushing. We're really taking our time to look for good investment opportunities to invest in.
And that is an ideal position to find yourself in. Just talk to me about those conversations you're having at investee company level. You obviously sit with generally the founder or the entrepreneur, the jockey, and you're now surveying the scene, looking for new opportunities. You already mentioned that you're in two great opportunities in this environment in fiber, and we're all working from home and doing a lot more at home. And the other one is obviously security. I think, unfortunately, one of the side effects of COVID-19, we're witnessing the spike in crime in our own neighborhood, is we will see a rise in crime, be it at a business premises or at home, and that obviously feeds into the security narrative. Where do you see potential opportunities on the horizon with some of your investee companies?
So, there are not a lot. There are a couple of small sectors in the market that are going to do well during these difficult times. The difficulty is assessing whether the benefits that they're going to achieve is long-term or short-term. So one of our investee companies, for example, will be entering the thermometer. As you walk into a shopping center, everyone's temperature needs to be taken. So they're entering into large contracts with the large property owners, for example, malls, to provide these thermometers on a rental basis. So as a result of COVID, there are new opportunities coming into place. And if you, because these are contractual or businesses that generate income from contracts, effectively, your commercials are achieved depending on the term that you can lock that the investee can lock its customer in. So these type of investments that we make, they're quite hands-on. For example, my partner will, in many cases, sit with the investee company and assess the contractual terms that they're going to enter in with their customer. Because if you get it wrong, then you're in a 2-3 year contract in commercial terms, which every single month you're going to really be. It's going to leave a sour taste in your mouth. So we're really hands-on in these businesses, and we're trying to make sure that they are successful.
What do you see the impact of COVID-19 being on future investments? Do you see more of that dry powder chasing an increasingly scarce number of transactions? Might that increase multiples that are probably attractive now, but into the future, say 12 to 18 months from now, how do you see the environment unfolding?
I don't have a crystal ball. I think it's going to be a really, really tough environment. We're fortunate that we're not sitting on historic investors' capital. We invested all our investors' capital. So we're in no pressure and we're no rush to invest money. I think the real opportunities will probably only arise in 12 to 18 months for fund managers, because a lot of these businesses are going to have to weather the storm. A lot of these entrepreneurs are going to have to come to terms with the fact that they're going to have to give a portion of their business away to a funder because they just weren't able to weather the storm. So I think the real opportunities will come in 12 to 18 months. I think at that point in time, there'll be some certainty. Just yesterday, there was positive news on a potential steroid, which is helping COVID patients. So it's really, really tough to determine. But as a business, we've taken the foot off the pedal. We are looking at investments, but we're in no rush to make an investment. And if a good one arises, similar to the fiber industry business that we're investing in, we would jump at a good opportunity.
I should have probably asked this right up front, but if you look at the total value raised so far on the Infinity Anchor Fund and the total deployed to date, can you just give us some color on that?
Well, pre-28 February, 100% of money was invested. We raised I think around 100 million Rand in February. And of that, we're about to invest a small portion into our first tranche into the fiber industry. So not a large portion. And I think the same would be said with every single Section 12J fund manager at this point in time.
There's a question here from Biko Machotsi, or more comment, saying he's not getting volume coming through. I'm hearing you in my can. So Biko, if you could maybe read my lips, I'm going to type to you now. Just unmute. Maybe it's on your side. Just moving now onto the Symbole Fund. Can you just give us an overview of what the Symbole Fund's mandate is and how much you've raised here specifically and deployed?
So Symbole is a property-backed Section 12J fund. We invest exclusively across Symbole and its holding companies' portfolio. I think what really sets this fund out from most Section 12J funds is that there's a guaranteed return and a guaranteed exit on 50% of our investors' capital. So what I mean by this is if you invest in Symbole Capital after the 5-year term, given that property is quite illiquid, if we struggle to sell off our portfolio, the first 50% of our investments, the what will happen is Symbole will come in and buy the first 50% of investments at a price which will guarantee a 9% return per year for the investor, excluding the tax benefit, 17.5% with the tax benefit. So investors will get half their money back at a guaranteed return. And what this will mean is the rest of the portfolio would have to continue to sell in the market. If you compare this to any other or most other Section 12J funds, they'd have to sell off their entire portfolio to generate liquidity.
So that's, I mean, demonstrates the resilience of that particular fund. What is the impact of COVID-19 been on your current investments inside the fund?
So, again, just fortuitously, the fund has been really unaffected. A significant portion of our investments is in student accommodation in Stellenbosch. Most of these leases are paid up a year in advance. It's a really great asset. It's a kilometer away from the university. So unless students don't go back by February, the fund will continue to perform. It's a great property investment. We're going to be investing more into, or we have already, or we're about to invest more into Lares now. That's our one investment. Our other investment is into a new hotel development. Fortunately, it's still being developed. We anticipated development to take about 20 months, but we actually thought it would take about 16. As a result, a couple of months delay as a result of lockdown won't really have a significant impact on the construction of the hotel. So really, our current portfolio unaffected at this point in time. In terms of future portfolio, we're going to be investing again into Lares. As I said, unless students don't go back in February, it will be unaffected. But really exciting, an exciting investment that we are really about to make. We finalizing negotiations, and our investors are completely unaware of this. So this will be the first time they hear about it, because it really wasn't on our radar. Because of COVID and other factors, we were able to negotiate with the CEO of Symbole and the group to invest in one of their lodges. They own a lodge on the De Zelza golf course called the De Zelza Lodge. Many investors would be horrified to think that we even consider investing into a hotel during COVID, but it's coming with an unbelievable guarantee. So what the Symbole group have guaranteed is after the 5-year term, they will buy back the asset at a property growth of 17.5%. So if we pay 100 Rand for it, there'll be a guaranteed purchase of the full value at 117 Rand and 50 cents. But what's really exciting is during the investment term, there's also a guaranteed yield. And the first year, 5%, scaling up to 10% in the final year. So there's a guaranteed yield in this investment and a guaranteed capital growth. This is all backed by a really unbelievable guarantee from Symbole. Their balance sheet's unbelievable. They recently finalized a transaction for the sale of a huge portion of land in Symbole. I think the transaction was between 150 and 200 million Rand. So they're sitting in a very good position. Their balance sheet's strong. And I think our investors are, this investment will give approximately a 15% return with a tax benefit over the 5-year term. In the property space, to have an investment like this during COVID, it's just, it's unbelievable. And we're really fortunate to have this type of partner as we do with Symbole.
And then you're sitting on a great asset after that 5-year period as well. What happens upon exit? I think just on that point, before I come back to whether those were compound annual growth numbers or total return numbers, at exit out of a VCC, what tends to happen for the investor?
So what tends to happen is the underlying portfolio needs to be liquidated. So, with us, we have guaranteed exit if we can't sell, but effectively we need to sell the assets. Cash then gets transferred into the fund. Obviously, there's other taxes that needs to be paid. And then we would typically look to buy back our investors' shares. These investors won't, I don't think, be able to sell their shares to a third party. One is the third party doesn't enjoy the tax benefit, and no one would really want to buy 0.5% or 1% of a fund. So we would typically buy back the shares. On sale, they would receive the capital, and they'd pay capital gains tax on the full investment amount.
So that answers that capital gains tax question right from the beginning. I've got another question here, Jonty, from Shaman Prem. Those investors that entered in February 2020, has that money been deployed? I think you answered that with the last question, but his second follow-up is, when can we expect dividends for that first investment? Everyone looking for dividends right now.
Yeah, so it's an interesting question. I think very fortunately, Larez, which is the student accommodation, and Jaltech, which is the property, they're both going to be yielding. Larez has at 100% occupancy for, I think, 10 years. So there'll be a rental income. Similarly with Jaltech, so if I had to guess, and this is really a guess and can't hold me to it, I think definitely, well, not definitely, but within this financial year, I would think that a dividend will be paid to our current investors.
Super. Prem, I'm sure that answers your question. And then on to the third fund, ORAC. I don't know if you've made any investments in this fund just yet. I couldn't find anything, just doing a bit of digging. But Jonty, you're at the coalface. Tell us a little bit more about the ORAC fund.
Yeah, so the ORAC fund is, for me, it's an exciting fund. Many people may know Pablo Fatides. Excuse me. He's on Cape Talk in 702 on a Thursday night with Bruce Whitfield, and he's an owner in a business called ORAC Business Accelerator. They incubate large businesses with a revenue of between 20 to 200 million rand, so large established businesses. And their business model really is they help these businesses grow their revenue, and they earn a fee on the revenue growth. Where we come in is we've started ORAC Capital, which is a relatively new Section 12J fund in partnership with ORAC Business Accelerator, and we're looking to invest into the portfolio of businesses which they manage, which is their clients. And the exciting part is we are making private equity investments, which is much higher risk investment in comparison to Symbole and Infinity. But the data in which we have on these businesses is really what sets us apart from most private equity funds in general. Their portfolio has a requirement to report effectively every month to ORAC. So this gives us really live data on these businesses. For example, what are the sales figures, manufacturing numbers, costs, etc. And we're basically seeing live data. So we can see how these businesses performed pre-COVID, during COVID, and then once lockdown and COVID starts to subside, we'll be able to see how these businesses are performing. And really what we're seeing here is a trend. And this trend will allow us to invest into these businesses at the right time. We're not rushing to make an investment in ORAC Capital. It's going to take us time. A lot of due diligence needs to take place in each of these investing companies, but because of the market conditions, being able to judge the right trend is really, really difficult. So for our current investors, we're not rushing to make an investment. We're looking to invest into really outstanding investments. We want to yield returns of 20 to 30%, because this is the type of risk or type of fund that this is, where Infinity and Symbole are going to give moderate returns, but more stable and less riskier, if I could put it like that.
Yeah, absolutely. And knowing Pablo, he's done a lot of his own due diligence on the pipeline inside the ORAC stable as well. So it comes as a partnership that has a lot of credibility. How is that partnership structured?
Yeah, so we are 50-50 shareholders in a fund manager. Our role, being independent from ORAC, is to ensure that there's a level of independence on the board, particularly around the businesses which we're looking to invest in, and they play an active role in managing the businesses. So it's quite an interesting question, because if you look at a normal private equity fund, when you invest into a company, that company all of a sudden has a new board member, trying to make decisions, interfere with management. Where with this fund, we're investing into businesses where ORAC's been sitting around the table in some cases for 4 years. So nothing changes. And the only difference is they now have more equity to grow these businesses. And we're really looking to invest into growing businesses. This isn't a business rescue fund or a VC fund or a startup tech fund. This is a private equity fund investing into businesses which are looking to grow.
And as you say, with that pipeline, that is absolutely critical. In terms of the size of the fund, how big is it, and when are you looking to deploy?
Yeah, so it's a young fund. We only launched the fund in August. This is our first fundraise. We raised around just over 20 million rand. A large chunk of investment came from ORAC Business Accelerator, so they're an investor in the fund. I think it's important to say that myself, my partners, friends and families, we investors in 12J significantly. So when we look into make investments in these funds, a lot of the time it's our own money also invested. So we're looking to make really wise decisions when managing our investors' capital.
Has any of that capital been deployed yet, or are you still doing your due diligence?
So in ORAC, no capital has been deployed. More than likely, probably to the end of the year or early next year. These type of investments are tough to make, but we don't want to create the impression that we are rushing into investments. If a good investment comes, we'll grab it. But in the current market, it's really been challenging to find the right trends in these businesses.
Then a question here from ORAC Capital on the share buyback at exit after 5 years. Would an investor have to exit 100% in one go, or could they split the exit over 2 or possibly 3 tax years?
Yeah, we would love our investors not to exit. We are incentivized to ensure that the fund performs, and the longer you invest in private equity, typically the more it grows. So we would love our investors to stick around for as many years. I think Infinity, as an example, I would be surprised if we were at the 5-year term now that a large portion of our investors would want to exit because they're getting a really nice yield at the moment. But to Rock's question, they could exit 30%, 50%, you name it. So it's really up to them.
I think it's an important point because there is a misconception that one is, after 5 years, a forced seller of these particular assets. And you by no means are. You don't have to realize any of those CGT events if you're enjoying being in the fund. I recall chatting to the head of Meju Capital a couple of years ago, talking about the exit that Brett had to do out of a particular asset that he was quite upset about, because he said he would have preferred that they held that asset into perpetuity, but the private equity model in that side basically said you've got to deploy back to your LPs after 7 years. So they had to exit, unfortunately. I think it's an inherent strength of the model.
No, definitely. I think the only restraint in 12J is the time in which you need to invest capital. So, up until the end of last year, fund managers had 3 years to invest capital. That was now increased to 4 years, which is not something I don't think it was a particularly good move from Treasury's perspective. I think, if anything, 12J fund managers should be under more pressure. Now, you mentioned that the market's at 10 billion, only 4 billion has been reinvested. So there's 6 billion rand of capital sitting in cash. And I think as an investor, sitting in cash is not a place you want to be, particularly where the repo rate is dropping every single month. So, that's an inherent problem in the market at the moment.
Yeah, it doesn't impose that discipline. And I think very often in the private equity space, where you talk about open-ended funds as well, and there's this move, ethos and its listed capital vehicle, permanent capital vehicle have gone down that route. But it's much better to have everyone's minds focused about finding those opportunities, and it imposes a certain amount of discipline that I certainly like about the model. There's a question here from Anil Govind. What's the guideline on certain prospective investments that do qualify for ORAC at present?
Well, first and foremost is that the invested company needs to be part of the ORAC Business Accelerator program. And that's a fundamental for us on many levels. We really not looking to, we're not looking for people to knock on our door and for us to consider them as an investment, because we don't know these businesses well enough. When it comes down to ORAC, they've been involved in these companies up to 4 years in some instances. So we really, we really have seen how these businesses have performed, how they're doing. We understand, we think we understand whether there are any skeletons in their closet. So ORAC has a mandate only to invest into ORAC Business Accelerator's portfolio. I think from an investor perspective, I think it'll give them a lot of comfort, knowing that Pavlo and Karine Engelbrach, who's his co-founder, have a real good grip over these businesses and how they're doing.
And just a follow-up there from Anil, who really appreciates you answering the questions. While we respect being cautious, long-term delay on deployment, clearly that'll have an impact on the inherent return over the 5-year period. What are your thoughts on that?
No, it will. It will have an effect. The problem is, in a market where there's such a high level of uncertainty, you don't want to have invested in a business where you're going to be stuck for the next 5 years in a business that potentially is going to be underperforming. So one of the issue in 12J is how do we exit investors? It's going to be particularly difficult to exit your investments when they're in underperforming assets. So although deployment is on the forefront of our mind, as a business, we don't raise more money than we think we can deploy in a single year. And we've done this for a number of years consecutively. That's our business model. We don't like to sit on capital. And as a result, we've got great returns in our funds. So we are very much incentivized to invest on time and within a 12-month cycle. But what we're not going to do is risk our investors' capital unnecessarily. The big question is, are we active in these funds looking for investments? Absolutely. We're not sitting around. We're not on holiday. We're looking for deals. When the right deal comes, we'll invest in it. But what we don't want to do is take unnecessary risk.
Yeah, it's that inherent balance and trade-off that one has to make, and that comes with experience. It comes with doing your due diligence. Are there certain, if you look at the ORAC fund, which seems to be generating a lot of interest, are there certain ORAC Accelerator clients that are performing well in this environment, much like some of your Infinity Fund investments?
No, there are a number of businesses that are doing really well. The issue isn't around their current performance. The issue is, is it sustainable? You don't want to invest in a business that had poor revenue 3 months ago, pre-COVID, and now all of a sudden they are booming. They are growing exponentially, but as soon as lockdown ends, they are going to be back to pre-lockdown revenue. So the issue here is you want to invest into businesses that are going to either continue to grow, or you invest at a point in time where you will assist in the growth, and then either the growth will continue or it'll flatten, but you'll have growth in your investment. Those are the companies we're looking at. So for us, it's important for the next 3 to 6 months to watch the trend. We may very well make investments in the next 2 months, but in the next 3 to 6 months to watch the trend in these businesses and see how they perform, so that when we know we can invest into a good company, a healthy company, and get good returns for our investors. But we're not looking to follow the trends in the 12J market of not investing capital. We want to invest capital, manage the money, generate good returns, and exit our investors on time.
Great. Well, I think that brings us to the end of this webinar, Jonty. I'd just like your concluding thoughts as to where you see the market over the next 6 months. I know you said it's difficult. Our crystal balls are very fuzzy at the moment, and probably the hardest thing to do right now for an entrepreneur, for a fund manager, is to forecast what the next 6 months are going to look like in South Africa. But just take me through your thinking and how you are doing your scenario planning and modeling for the various eventualities that might transpire.
Yeah, I think over the next 6 to 12 months, it's a bit of a long period. I think the opportunities are going to be really phenomenal. And I think there are going to be a number of entrepreneurs who are going to realize that, without a private equity partner, they're done. So instead of having 100% of nothing, they're going to be accepting 50% of something which will be sustainable over the next 5 to 20 years. So I think there will definitely be great opportunities. I think as a fund manager, it's important to maintain your current investments. So that's something that we always have our eye on. I think competing funds are struggling. If you look at the property sector, during 2019, 60% of investors went into property-backed Section 12J funds. I think those assets are really, really struggling. It's apparent from the noise in the market. So there'll be a lot of fund managers that are really focusing a lot of their attention on resuscitating investments if they can. From our side, business as normal. We're looking to invest capital. I think one thing that the listeners would be interested to hear is we're hoping in the next month to receive the next draft of the DT lab. And often in the DT lab, there are amendments to Section 12J, and we're really hoping that there will be reference to the sunset clause, which for many of our attendees would know that you can enjoy investing into 12J up until the end of June 2021, which is next year. And we're really hoping that an extension is imminent. Our feeling is that that Treasury will extend the sunset clause, but if Treasury doesn't, all that means is, current investors who invest up until the end of June, they'll continue to remain invested up until the end of the term of the investment, and then they'll exit. But I think the South African market really needs 12J to be extended. I think more and more investors, and we've seen an increase of about 250% growth in our investor base, investing into 12J, creating equity funding to SMEs. And I think that's what the South African market now needs more than ever.
More than ever critical. So over to you, Tito, on the 24th. All eyes will be on what comes of that budget, and we'll be rummaging through the notes and addendums furiously. Jonty, as always, a great pleasure chatting to you, getting your insights into the Section 12J market. There are a couple of questions that we left on the table, but we'll have to invite listeners back for the next one. I'm sure we're going to be doing a few of these in the future. So everyone, thanks for listening. Jonty, to thank you as well. Take care.
Thank you very much, Michael, and thanks for your time. Really appreciate it.
Always a pleasure. Always a pleasure. Cheers.
Cheers. Bye.